For a closer look at the volatile markets, let's bring in David Tice, president of Tice Investments, who correctly predicted the bear market in October of '07. He founded the Prudent Bear Fund in 1995, and he currently serves as a consultant for the bear markets at Federated Investors. He joins us now on the phone from Dallas. David, welcome to Bottom Line. Thanks so much for coming on today.
Glad to be here, Mark.
David, as we were mentioning earlier, we saw that, S&P 500 poised for that fourth straight weekly slump. And yesterday we learned of a sharp decline in U.S. home sales last month, that more people filed jobless claims last week. And then you have Morgan Stanley cutting its forecast for global economic growth for this year and next. Are we seeing a replay of '08? Is the climate one of uncertainty or one of fear?
Well, there's certainly uncertainty and there's certainly fear, and things are a little different than '08, but there's a lot of similarities, and now we have a problem of sovereign debt. Essentially, the central banks around the world have thrown, liquidity at this market, fiscal stimulus, et cetera, buying, trillions of dollars of backstops and cash for the system, and we have disrupted currency markets. People are fearful of the euro, people are fearful of the dollar, and therefore they're buying a lot of gold and silver. And the economy is slowing down now. Consumer confidence is really starting to fall, and we're definitely at risk of a double dip.
David, my colleague, you know him well, Matt Miller's down at the New York Stock Exchange, and he wanted to ask a question. Matt?
Yeah, David, David, I'm wondering why this doesn't seem like a replay of March 2009, because we've seen, according to ISI, hedge funds get the most bearish they've been since 2009. It sounds almost like capitulation there. We see valuations the lowest they've been since, I think, March of 2009. And we see insider buying at the highest it's been since March of 2009 after the big drops we've seen since April. Are we primed for a turnaround here?
I really don't think so, Matt. I think we do have further to fall. Of course, I've tended to underestimate the degree to which markets do snap back. However, I think we do have a lot more problems. You look at what the currency markets are telling us, what gold is doing, the fact J.P. Morgan analysts are talking about gold reaching $2,500 by the end of the year. I mean, these are extraordinary times, and I still think we have lots of problems in Europe. I still think China is a massive bubble, and now people are losing confidence at the U.S., and I believe earnings are going to disappoint, and therefore these PEs that people think are relatively cheap may not be as cheap as they look.
David, we have about 30 seconds left in this segment. I wanted to ask if you could stay through the commercial break, because Matt and I have a couple more questions. But before we go to break, we have heard a lot of analysts and economists tell us this week we could be inching toward another recession. Are we headed there? How bad is this?
I think we're going to have another recession. That's definitely my belief. You look at the fall of consumer confidence, you look at the fact that housing prices are now declining again. Most of the GDP increase that we've had over the last several years has really been in consumer, in healthcare, and in government. And really, those are not productive areas of growth.
David, I wanted to just ask you firstly, how far you think we could fall here. I mean, we come down almost 20% now from the April highs on the S&P. The MSCI come down about 15% from the June highs. How far down do you think we could go in this market?
Matt, I really think we could fall to the 8,000 or 9,000 level on the Dow. I used to have some levels a lot lower than that. Now we've printed so much money, and there's so much money sloshing around the system that we probably don't fall further than that. However, we could have a rally after that. We could decline further. We're going to be in for years of pain, unfortunately, because we've had a government solution. Central banks have jumped in, and now we have a sovereign crisis, and you cannot solve these problems by, if you have a problem with too much debt, you cannot cure this with more debt, be it public or private.
Does Europe have a chance to get it right where we have gotten it wrong, David? I mean, they have put austerity programs into place and haven't yet printed the kind of money that we have seen out of the U.S. central bank.
Well, Ireland is doing some good things. However, you look at Greece, you look at Italy, you look at Spain, these countries are basket cases. And we think without the coordination between fiscal and monetary policy, that they still have massive problems ahead. And it's just very, very difficult for the Germans to go ahead and bail out. It's like their spendthrift brother in Greece and Portugal, etc., and for Germans to take the pain. And we think there's going to be a lot of reluctance there, and that's certainly playing out.
David, earlier today, Robert Hagstrom of Legg Mason told my colleague Mariam Namazi that the current market climate is what he described as kindergarten investing. He said that psychologically it's a difficult time for people to get into the market, but that mathematically it's very easy. But then Bert White of LPL Financial told us that, quote, cheap isn't cheap enough when you have a confidence problem. Who's right?
Well, certainly a confidence problem is what we have, but it's not just confidence, and there's some people that just say, oh, the market's okay, and it's just fear. The problem is we have a screwed up system, and we did not fix things after the 07-08 crisis. What we've done is we've thrown a lot of money at this, and we've moved the problem on the private side to the public side. And essentially the whole Keynesian economic theory, we believe, is flawed, and that you cannot, just throw money at this and bankrupt, governments, which is what we've done by adding trillions of dollars to the system. The system's in trouble.
Well, I wonder what your take is. I mean, looking forward, you don't have any optimism that we're going to veer away from those Keynesian policies. So what do you think we're looking at as far as unemployment, as far as inflation, as far as the value of the dollar going forward, David?
Well, I do think that unemployment is going to go up. In terms of inflation, that's still a hard call, between inflation and deflation. There's some very smart bears out there that are on both ends. A lot depends on what happens with velocity. And, that's still kind of up in the air. I tend to lean towards increased inflation. We're already up 14% in terms of input prices in the U.S. We're seeing PPI starting to pick up. However, we could get another deflationary leg down with, a collapse in the stock market. So it's tricky. In terms of the dollar could rally for a little bit here as there's more and more with liquidity problems and people paying off dollar-denominated debts. The dollar could increase for a while. It's going to be very, very tricky. But I do believe it's going to be more volatile, and the U.S. will face a standard of living decline.
David, what about the Fed? Do you see the Fed with any more bullets? Do we see QE3?
Right now, there's been a lot of people at the Fed, 3 gentlemen from the Fed providing dissenting votes there. There's a lot of people that don't feel like we should go to QE3. If the market's down another 10-15%, they probably will announce it.
David, about 15 seconds before we let you go, Matt just mentioned about the Fed. Mr. Bernanke is going to be speaking next week in Jackson Hole, Wyoming. Are you expecting him to say anything?
Well, he always says something, but unfortunately, he unfortunately, in my opinion, is following bad policy. And I believe that we have to get back more to a gold standard. I mean, this is a guy who said gold was not money. Gold has represented the backing for the world's currency of commerce for thousands of years. It's only been in the last 40 years that gold and silver or some precious metals has not backed it, and that's why we're in such trouble today.
David, always a pleasure to talk to you. David Tice, president of Tice Investments, joining us from Dallas. My colleague Matt Miller on the floor of the stock exchange as well. Thanks so much.